Rajiv Sabharwal, MD and CEO of Tata Capital, to understand the roadmap ahead. Let's take a look.
Actually, we are present across all segments and we are seeing a good buoyancy in all segments. Obviously, the largest segment for us is housing loans, which is showing a growth of about 24% plus. We are seeing strong growth happening on the retail side, both on the secured and the unsecured side. SME growth is moderate, and we are seeing good growth also on the corporate side. So the vehicle segment, again, is showing good promise of growth. So the growth is well diversified, which is the good part and which we feel very good about. And that actually makes us believe that this year on growth should be very good.
Give us a sense of the trajectory for the NIMs actually, because there's some softness that we saw in Q1 for NIMs at 5.03%. Where is this softness coming in, and can that be reversed by the end of the year?
So I'll give you a sense of all elements which go into a P&L. So growth is good. NIMs, we saw a softness there because in Q1, the cost of funds has increased. However, the way we are looking at it, it is moderating now. And we have, with our focus on increasing the proportion of high NIM products and also increasing margins on all products, we are fairly confident that the NIM will increase this year. We are also seeing significant advantage on operating efficiency. Our cost to income is down by about 190 basis points compared to Q1 of last year. And we are seeing credit costs also trending down. In fact, the slippages are much lower. So all of this makes us believe that on credit cost also this year should be very good.
You know, the cost of borrowing went up by nearly 20 bips for you, and you're seeing that, you're seeing it now trending lower. It's trending lower now. How are you countering it? Is the cost to income efficiency or operational efficiency the way to look at it?
So there are two areas on which we do believe that there is a significant upside which will happen to us over the next few quarters. One, our operating efficiency. We are seeing the advantages of the projects which we have done on GenAI coming to fore, and it translating into elements which are giving us improvement in cost to income or cost to average assets. We're seeing productivity jump in all areas. For example, just to give you a sense, our manpower just increased by 5% last year, while our AUM has grown at 22% plus. Similarly, on margins, because we are focusing on higher margin products more, and in each of the normal margin products also, we are looking at how we can increase margins. And they have, on a month-on-month basis, they have started showing a positive trend. So we are fairly confident that margins will improve this year, and operating efficiency will also see an improvement. These are the two big levers which we are focusing on to improve our ROA.
You mentioned about the fact that you're looking at high margin products, and I assume that is going into retail and SME and micro housing that will have some portion of unsecured as well. What is the strategy there for you? Therefore, for you?
So our retail unsecured forms about 10.3% of our total book, and retail unsecured as well as affordable housing, micro housing, secured business loans are some of the products which will give us more margins. And these products will grow this year by Q3, Q4 at a faster pace than the rest of the book, thus helping us increase the proportion of high margin business in our overall book. So this is how we are planning our future. But even with this increase, we do believe that our retail unsecured will remain within limits which we have set for ourselves, while they will help increase margins, but we will largely remain a secured lending business.
From the credit cost point of view, it's hitting 1% as of now. We saw a 10 bips increase in credit cost during the quarter. Do you think you have the levers to bring it down?
So we had guided for a credit cost of less than 1% by FY28. Actually, we are a year ahead on our guidance on credit cost. If you look at Q1 of last year, the credit costs were 1.6%, which are now down to 1%. So it's a 60 basis points drop there. Similarly, What happens is quarter four is usually the best quarter for on credit cost. We have seen that play out with equal fervor in Q1 for all retail products. It's only in motor finance, where the commercial vehicle business, that we have seen a slight uptick of 10 basis points, but that we believe is seasonal, and we should see that also trending down in the future.
How are you looking at the entire Tata Motors book, finance book, which you're trying to bring it down as well? The impact of that on the consolidated balance sheet as well. Where is that standing now, and when do you think that it will get normalized?
So we are trending very well on the transformation journey for Tata Motor Finance. We wanted to change the mix of assets. That is happening. That's progressed very well, and which is also helping us in improving our margins. We wanted to bring down our cost to income in that business. It used to be 70, it's already down to 55, and we feel there is huge potential to bring it down further. Credit costs are down in that business. I think the only place where we are now focusing on is how to increase volumes with these higher margins and lower credit costs. When I look at month-on-month numbers, they are trending well, and we should see further improvement happening in Q2 and Q3 here.
You've guided for 23 to 25% AUM growth over the medium term. Is retail, housing, and the high margin business going to be the levers for that medium term guidance that you're given?
Our biggest growth segments would be housing, retail, and SME. That will form the bulk of our business. Today also they form 85.4% of our total book. So we see good growth happening there. But while these will grow, the high margin products will grow at a faster pace than the overall book. You should start seeing this happening on our book from Q3, Q4 onwards. The disbursements on all these products are trending well, which will soon translate into a higher book growth too.
Rajiv, you have also guided for a return on asset of nearly 2.5 to 2.7 by FY28, and my assumption is that as you trend towards that guidance, you'll see your NIMs also inching higher. What is the kind of NIMs targeting that you're doing as you inch towards a ROA of 2.5 to 2.8%?
If you look at the ROA in quarter one of this year and quarter four of last year, our overall ROA is 2.3%, and excluding motor finance, the ROA is 2.5%. We are seeing this path of going from 2.3 to 2.6 to 2.7 by FY28, and you will see the improvement happening with every quarter. If I have to dissect this improvement, we believe 2/3 of the improvement will happen through margin improvement, and 1/3 will happen through operating efficiency. Operating efficiency will, we are seeing clear benefits of all the GenAI work which we have done. That is all translating into improved productivity and then into lower cost to income.
Is there a way you can also quantify this GenAI, how it's improving your margins, in what form, or how much of margin increment came in because of the productivity increase that you have used GenAI for?
So we are using GenAI across the system. It's for sourcing, it's for credit assessment, it's for operations and customer service, and then also for collections. We have trained already 12,000 people within the organization on tools which they can use for using GenAI. The whole idea being that if we can make our employees, very literate on this, then they will themselves use this and bring benefits to the organization. Just to give you a sense, 80% of all our creatives are getting made through GenAI. When I look at our operations team, in the last 3 years, we have not added any member to that team, with our volumes almost more than doubling. So that's the benefit. If I look at productivities have increased in credit by about 40% or so. And all of this is translating into we needing less number of people to do more business. And that's a sense I was giving. We've just added about 5% to our workforce, and our book has grown by over 22%.
Interesting. Another thing which is coming out very clearly is the kind of efficiency that you're bringing in. And you also spoke about the fact that Q3 and Q4 is where you're going to see high margin business having a sizable impact on your margins. Are we to see margins hitting around 5.1% as you exit FY27?
So we are definitely looking at, for the year, a margin improvement of 10 basis points. There are many levers at play, so we are fairly confident we will get there. And if all remains well, we will try to see if we can do better. But that's the aim which we have of 10 basis points improvement.
And with that, it's a wrap on this edition of Midcap Masala. From me, Ashesha, and everyone who puts this show together, thanks for watching. Buy Now, Sell Now is up next.